Hi guys, this is Investing with JYK, and today we'll talk about arbitrage. I'll actually provide you with an example of an arbitrage. So arbitrage is essentially buying uh, one. Well, if you have two substantially similar securities and then they are priced differently, you could buy one and sell the other and essentially get the difference. And how do we do that? Now let's get into an example. So I have this arbitrage uh, spreadsheet in which I keep track of a bunch of mergers that's going on, and the top one, we'll just take a look at this one. Top one is AG, which is First Logistics Silver. They're buying PPPMF, which is the ADR of Primero Mining, and this is the most important thing. Obviously, the annualized return is going to be like 200% plus, and the actual gain is only 7%, but it's going to close very soon. So it's actually the annualized return is super high. So how do we come up with these numbers? Okay. So this one is easy. It's just price of AG, and this is the price of PPMF. But since these are penny stocks, this is a penny stock, you have to look at a few more digits. So when you go to a brokerage, they will actually provide you with a more fine-grained quote. In this case, maybe like 0.185, 187, or 189, something like that. In fact, it goes to like 4 digits after like 4 places after the digit, the point. It was I've seen something like 0.1873 or something like that. So that's fairly simple too. And then these are just stock market caps, and you can see this one is a tiny market cap, it's 35 million. This one is a $1 billion company. And the stock ratio, we need to find that out. And with that, we can compute the target value. And these are just fees that I computed. And then these are basically, I just put in the number of targets shares, and with the stock value, it computes the number of purchaser shares after short. And then I just compute the gains. Okay. So the important thing is how we find out the stock ratio. So in First Logistics Silver's website, you can see in here, this says they will buy I think it's for every share of Primero Mining, you get 0.03325 share of the First Logistics. It's essentially like 30 to 1, right? If you look at it, it's basically 30 to 1. Otherwise, it's going to be 0.33333 or something like that. But 3325, it's 30 to 1. So for every 30 shares of Primero Mining, you get 1 share of First Logistics Silver when the transaction closes. Okay, so that was announced in January 12th. And there's some stuff in here that says this one is contingent on require approval of 66.666666% of the votes in Primero. So that's one hurdle. Second one is going to be court approvals, so essentially like antitrust clearance and all that stuff. Okay. And then it has a bunch of stuff in terms of like Wheaton. So Wheaton, and also, yeah, there's the Primero's debenture holders have to also approve this thing. Wheaton has approved this thing because Primero actually took out a Wheaton stream, and that's essentially what screwed them up. So they had to sell themselves. Okay, so we know that 0.03325 comes from here, so that's simple then. So for every single share of this guy, PPPMF, you're going to get 0.03325 3325 shares of AG. So so this is in US. You could do it in Canada too, which is much easier because there Primero is just traded normally instead of as an ADR. And so the actual value, you can multiply this thing by that, and then that would compute you the value, the target value. So that means each PPPMF is currently actually valued at 20 cents plus. That's interesting because now we have a 7% difference between what it should be worth, essentially this number, and it is worth. So the substantially similarity exists because by the time the thing closes, all your PPPMF shares will be transferred into AG shares. And then you can essentially hand back the shorts. So you would buy, let's say, 30 shares of PPPMF, and you will short 1 share of AG. And by the time the transaction closes, because of your 30 shares of PPPMF, you get 1 share of AG, and you hand back the AG share to cover your short, and you're done. And you get your cash from shorting the AG at $6.12. And the actual cost of buying 30 shares of this is something like 30 times .19, $5.7. See the difference? Okay, so that seems all nice. So what are the risks? So one website I use often is well, not website. I listen to the webcast, the podcast quite often, and then this is what works in investing, and he talks about arbitrage as well. So he has a good checklist. You can look at this. One of his purchase price in all cash. It's not true in this case. So I have to short and long at the same time, right? To mitigate the risk of AG going down in prices, and that's very probable because it's a mining stock. So if silver goes down in price, their price will drop a lot as well. And then you got buyer pays a fair price. Yes, this is only important in terms of like the purchasee, the company getting bought, their shareholders, will they approve that deal? And in this case, they did. So both their shareholders and their debenture holders approved this. So this actually is a moot point. And then you got big fish swallowing little fish. So that he explains in this case that there's a lot less regulatory risk involved, which is true. In this case, we got a $1 billion market cap company buying a $35 million. So it's like 3% of the market cap. So definitely a big fish swallowing a small fish. And the little fish is profitable and valuable. The little fish is not profitable. That's why they have to sell themselves in this case. The reason it's valuable is that if you look at their resource estimate, just one of them, they have one mine and one exploration project. The mine, if you look at just proven probable, we discount the we discount the measured and indicated, right? So proven probable, you got 5.5 grams of gold and 315 grams of silver per ton. So that is a lot of minerals. So in fact, you can do 5.5 times the value of gold, which is $42 per gram, plus 315 times silver, say I think it's 53 cents per gram. And then let's say we're just gonna say metallurgically, we lose. The recovery rate is low. Let's say we do a 0.8, 80% recovery rate. This is $300 per ton. So these ores are $300 per ton. Okay, let's say that we take a further discount. It's $300 per ton, right? So how much is the cost of mining? So their estimation of cost of mining was something like 100 and where is that? Milled. Yes, cost per ton milled was $110. Okay. So you say 300 minus 110, get $190 per ton in profit. And then you multiply that by the number of their mines. Proven probable here. Sorry, number of tons of ore they have. So 4893 million. It's 1,000, it's a million, yeah. So you get close to $1 billion in value. So let's say, divide by 1 billion. Yeah, you get close to $1 billion in value. And the transaction size is 360 million, I think. Valuing it something like $360 million. $320 million. Yeah. And these are Canadian dollars too. Oh, sorry, US dollars. Yeah, these are US dollars. Yeah. So 320 million. First, Majestic bought something that potentially can produce $1 billion. Obviously, that $1 billion is not MPV. That's just the if you exhaust the entire ore. So MPV wise, it's not going to be $1 billion. But the mine is already built, so they can just start producing. The whole reason Primero is dying is because their Wheaton cut in a lot into their profit margin. That's what killed them. They also had to sell one of their exploration project to McEwen mine, and they spent something like $100 or $200 million drilling, and the McEwen got it for $25 million. So yeah, so debt, or in this case, streams, will mess you up very badly. So that risk is no longer there. Yes, it's very valuable. There's no other bidders, but in this case, it's like you're looking at a 35 million market cap. Sorry. Yeah. So 320 million is really like the entire transaction size. So they also have to pay debenture holders as well as Wheaton. So that's why it's $320 million. But let's see. There's no other contingencies. That's true. So Wheaton got on board, and it's not hostile. The target board approved it as well as the shareholders. So everybody approved it. The only thing that's left, as they say here, I think said something like, oh, here we go. The company will now seek final order from Supreme Court of British Columbia to approve the transaction. The transaction is expected to close before the end of April, which is why I put the end of April here. So if it closes anytime earlier or anytime sooner, the annualized return will be even higher. So yeah, so these are, yeah, somehow the other risk is liquidity, right? So how many shares of PPPMF can you legitimately get in a day? So the average trading volume in the 30 days is 125,000. So in terms of dollars, divided by 5 is really low, 25K a day. That's the entire trading volume. So legitimately, you can maybe expect to get to 0.1, 10% of that. So maybe 2,000 or something dollars worth. You're not gonna get a lot of shares, but it's fantastic for people with a small amount of capital because you get a huge annualized gain. And so this is a spreadsheet I maintain. I've bunch of them here. And the reason I started looking into arbitrages is because of sorry, it was Buffett. Buffett said workouts. What does he mean by workouts? Arbitrages. And you can see it's mergers, regardless. And then he said the predictability coupled with short holding period produces quite decent annual rates of return. And I remember reading somewhere when the markets are high in terms of valuation, Buffett went much heavier, much more heavily into workouts. And when the market is not overvalued, he had more in what he calls generals, and I think workouts and controls, both of them, he relied on a lot more when there's overall overvaluation in the market, because these have a different return profile than the market itself. And by market, I mean Dow Jones or S&P 500. So that is why I started looking into these, and may be interesting to you guys as well. So hopefully you got something useful. I will actually just leave. I will share the link to this spreadsheet, and I don't promise all the numbers accurate. They're accurate to my knowledge, and I rely on these, but it is entirely possible I got it wrong, and in fact one of them I marked it out as the formula is wrong. So if you know something is wrong, please let me know, and if you notice something is wrong, let me know so I can correct it. And also, oh yeah, one more thing. Because we're looking at AG and PPPMF. AG is fine. AG is First Majestic has both Toronto traded shares and US traded shares, and Primero has Toronto traded shares, and then they got delisted from NASDAQ, I think, because they became a penny stock. So they only have ADRs, in fact a pink sheet ADR. So because of that, I asked the First Majestic Silver's investor relations, asking them, what's going to happen with my PPMF shares, what kind of First Majestic shares I will receive. And so he replied that if you have it in the brokerage account, it will be transferred to First Majestic and all that, and then it will happen 5 to 8 days after the closing of the transaction. And he said if it's held in the US, you will receive AG, which is traded on NYSE. So that's good. And yeah, so that's all the information I have for you. And see you next time.